Hi everyone, this is Rob Roy of Elliott Wave Options, and welcome to TradeFinder Live. Apologize for the few-minute delay here. It's on my end, my fault, having a little bit of a technical difficulty with the wireless. Live in Florida, and it's pretty stormy right now, so I don't know if that has anything to do with it or not, but just before, literally about 4 or 5 minutes before we're supposed to start, I got this really loud, no, not that you care, but got this really loud noise in my ear and everything froze. So I had to go through the process of restarting, but we're here and we're ready to go. So with that said, let's go ahead and move forward. As you know, we have to go through the, let me bring it up here. We have to go through the disclaimer. Here's a chart that I wanted to show you. There we go. There's the disclaimer. And as we've talked about each and every week, take a screenshot of it, go through and read it. I'm not going to read every word for you, but the two primary things that you need to know that the securities people want us to make sure we relay is that we are not licensed as registered investment advisors to give advice in the U.S. And any pricing that we talk about, unless noted otherwise, will be denoted in U.S. dollars. So those are the two primary things to take away from that. So with that said, we'll move forward with the TradeFinder agenda. And just as a refresher for those of you that may be new in this session, the way we do the TradeFinder is we go through this part and then we take a look at the market itself. I'll give you just a brief rundown of where we are, what happened in the current day, interesting things that occurred towards the end of the day, which I want to show you. And then we'll take a look at our case studies from last week. We'll look at a current case study from our website, and then we'll see if we can find anything that's worthy of following for next week in the TradeFinder. So that's the process that we go through with this class, and then I'll finish up with as many questions as I can get to in our allotted time, and we want to respect your time and understand that it's valuable as well. So with that, let's go ahead and move forward. And first thing that I wanted to show you, and I'm working on getting better at learning the intricacies of going through this webinar process and sharing the appropriate screen so that it's easier for you to see. Hopefully on your screen you can see where I have a chart of the market from today. This is the E-mini futures, and I do look at a 3-minute chart on a daily basis. So kind of what I wanted to show you is towards the end of the day here, if you watch the trade scan series, we talked about how when we're dealing with price, focus on the closing price. You can do open, high, low, or close when you're creating searches or scans or whatever. And the closing price is the most important price of the day, in my opinion, because it captures the last hour. The last hour is when institutions trade. That's when the big money, if you will, the smart money does what they're going to do for the day. They let the retail traders have the majority of the day. You may have noticed over time in following the markets that whatever happens throughout the course of the day can quite often change drastically in the last hour. You could have had a big down day and you rally into the close, or you could have had a big up day and you sell off into the close. That's because that's when the big money institutional traders are coming in. Yesterday was the first trading day of the month, which is also typically a bullish day, because whether you're dealing with IRAs, 401ks, et cetera, mutual funds, those that have dollar cost averaging type programs, that money comes in throughout the month. But then on the first trading day of the month is when the institutions usually put that money to work. So the first trading day of the month, not always, nothing's 100%, but that day is normally a bullish day. It was yesterday, ever so slightly, but look what happened into the close today. So this move, this big move up, and look at that volume spike. So when I was talking about the institutions trade in the last hour of the day, that was a huge move from some big money. That's not retail traders causing a big move like that. That was an institutional buy on the close program that caused this big move to the upside. So we opened higher, we kind of traded down throughout the course of the day, and then towards the end, boom, you had that big spike. And as you can see in the inlaid volume there in the blue area, that massive volume spike. And I don't think I have to expand any more for you to realize that anything that produces that kind of volume is more on the institutional level. So we can kind of debate, was that mutual funds? Was that a really big investment fund? Was that the Federal Reserve? Who was it that came in with that kind of volume, the biggest volume spike of the day, right into the close? And at this point in time, the futures are up 12 3/4 points. So basically, you see that high there at 3079. We're at 3092 on the futures right now. So we had that big spike right after the close. We went sideways for a bit, and then we've moved to the upside since then. When you get a big spike like that, it forces the shorts to cover, and we've gone through this whole area of the 61.8% level. So I'm going to take this off the screen, and I'll go back to showing you where we are currently in the market. So let me change the window and bring this up. And so hopefully you're seeing the chart of the S&P, and you can see we're getting awfully close to that 78.6% level. Now remember, the thing that we've been looking at is the 61.8% level where we had resistance. The market came up, boom, hit it, came back down to the previous level, hit it again, came back down to the previous level again, gapped up. So we're still sitting there with this gap, which at some point in time is going to get filled. I just hate it when there's gaps sitting out there. Much prefer them to get filled. Now the gap got filled over here in this area right here at the 300 level. So that gap got filled. We don't have to worry about that one anymore. And if we go up and hit the 78.6% level, that negates this downward zigzag pattern that's been qualified. Now, there's a lot to talk about with this downward zigzag pattern because we had a qualified zigzag here, an entire zigzag pattern that completed itself. Then we had another zigzag pattern to the upside, which also completed itself. So those two completed themselves. They're patterns within themselves. But when you have a big pattern, you also pay attention to that. But it may turn out that this is an extension of this zigzag pattern that started here back on these lows. We'll find out if indeed we do hit that level. And that's at 313. We're not there yet, even with the futures being up after hours, but maybe we get there tomorrow. We'll wait and see. Now, what that means is that the big downward zigzag pattern becomes disqualified. And so you have the completion of this big zigzag pattern down here and this one to the upside. Those become completed. And then we hit here and we're looking to move up towards the previous highs. And boy, there's been an awful lot of discussion and there's passion on either side, isn't there? Those that are saying the market's going up and it's going up because of Fed liquidity. It's more than that. Fed liquidity is certainly having its effect on the shorts and causing shorts to cover. But the market is bigger than even the amount of money that the Federal Reserve is injecting. Now that, again, has an effect on it, but it's more than just that. And then the fact that to go up and test the highs would be hard to fathom with everything that's going on, not just with the virus, but now all the civil unrest that we have, the demonstrations, and not just demonstrations that are occurring, but the violence and all that's occurring in them. We did a recording not long ago where we talked about another potential black swan where we talked about anarchy, and that was because the protests were having businesses forced to be shut down and the economy forced to being shut down. So the economy reopens. They avoided that, but now we have the civil unrest similar to what I was talking about in that black swan type. I just find it kind of ironic that we had talked about the anarchy type of situation as another potential black swan, and now we have it just for a different reason, but the same type of thing that we were talking about. But the market still is moving to the upside. So there is a huge disconnect right now with what's going on in the stock market and what's going on in the economy, what's going on in the civilian population, etc. The market continues to climb. Well, all this stuff is going on. And I know, and based on the comments that have been made on the S&P update video that did last night, people are having difficulty understanding how the market can go up with all this stuff going on. It doesn't really matter if we're confused about the fact that it's doing it, or if we don't understand why it's doing it. The market's going to do what the market's going to do, and we have to trade accordingly in our portfolio. And we'll take a look at that here in a couple minutes. In our portfolio, we've had a number of bullish trades. We have had a bearish position. The debit spread, I put debit spread on the SPY because that downward zigzag was qualified. But we've also had a number of bullish positions, a number of strangles, etc. So we're trading with what shows up on our search results. We're not just sitting here thinking, okay, we have a qualified downward zigzag pattern, so everything that we're going to do is bearish. No, we haven't been doing that at all. We have one bearish position, but we also have an awful lot of bullish positions. We have a bullish position on Google, which also popped at the close. And that one that we had talked about last week, we showed, just to give you an example of some, popped nearly $8 on that spike that I showed you right into the close. And that one's over a 50% gain now, that out of the money butterfly. And if this upward move holds into the open tomorrow and Google pops up, we may very well close that one out and be talking about that one next week as a really nice out of the money butterfly to the upside. But it's very important to keep an eye on this 78.6% level with the market itself. I also wanted to show you the VIX. We talked about this in the market update last night, where we said that this was starting to become very close to that kind of launch pad type of a scenario where you go really sideways for a while. Normally you get a blast off to the upside, but boy, that is one heck of a nice looking descending triangle. Now, there was a comment on the YouTube video from last night stating that, well, you're going to get a downward breakout out of the descending triangle. Remember, just because it's a descending triangle, and this is a common misconception, that people think a descending triangle means for sure that we're going to get a downside breakout. Maybe we do. Maybe we break out of this triangle and we come down and we fill this gap that's been occurring in the VIX. But just because it's a descending triangle does not necessarily mean that we're going to have a downside breakout. We could have an upside breakout as well. All I'm saying is that there's a lot of people out there that think ascending triangles mean you're going to have an upside breakout, and descending triangles mean you're going to have a downside breakout. The statistics over time, where you've tracked these and followed them, show that it's still up in the air. It still could be either direction. There's no favoritism based on the pattern on the breakout one way or the other. So it could still go either direction. So the downside breakout is not a given. Maybe that's what happens, but it's not a given that we occur with a breakout to the downside. I also wanted to show you, and we're going to talk about this more in the next market update that we do on YouTube. We've been waiting for the dollar to move, and you can clearly see that we have made a substantial downward breakout on the dollar. And that kind of becomes a catch-22. For a while, a weaker dollar is positive for the market. So that is giving fuel to the upward move in the market. So you can see that there is a correlation between the two, where we had this sideways move here with a 61.8% resistance, and you go back and you look at the dollar while the dollar was consolidating. Then we start to get a breakdown in the dollar, and that coincides with this upward move that we've had in the market. And that's the way it works. You devalue your currency, and then you get the exchange rate benefit, and that helps companies that have international exposure. So that's the reason that the S&P tends to move up when the dollar moves down. So that'll be good for a time, but there will be a point that if the dollar starts to continue down, and it occurred down here when we started to get towards the lows, when the market was cratering, there'll be a point in time where it's like, Okay, now the dollar is getting so weak. Why? It's still viewed as the safe haven currency. And if it starts to really collapse, likely under the weight of all of this Fed stimulus and all the Fed liquidity that's being pumped in, what if it begins to really break down? That's not a good thing because that's a sign of an economic downturn, a further economic downturn than what we know is existing already. So we want to keep an eye on this. So for a point in time, it's a good thing to have the dollar weakening. Again, it fuels international companies, but there will become a point if the dollar continues lower, then you start to say, oh, wait, that's too much. The bond hasn't moved. The 10-year bond, this really, really surprises me. Not that the market doesn't surprise me on a consistent basis. I've been doing this for 25 years and I still get surprised. But the dollar or the 10-year bond really hasn't broken out yet, even with that significant move out of the dollar. But it will. With that kind of a triangle, you're going to see some sort of a similar pattern as far as a breakout, not suggesting that the bond breaks to the downside. It could break to the upside. I'm just saying that we will see a breakout similar to what the dollar did because it's the same type of a pattern. It just hasn't broken out yet. And with the issuance of new 20-year bonds, et cetera, I really thought that would have an effect. Hasn't had any effect whatsoever on the 10-year. None. Just like it never even happened, which again is mind-boggling to me. So that's a really brief update of where we are in the market. Again, we'll talk more about this in the next S&P update with this breakdown of the dollar and what's going on with the currencies. The metal markets are really on fire. A little bit of a pullback today, but silver has been basically going vertically to the upside, which has worked out well for our current bullish spread that we have on silver. You just look back and say, gee, I wish you would have had just straight calls. But when you get a vertical move with all the gaps, the prudent thing to do is protect yourself with a spread, and that's what we've done. So let's go ahead and take a look at a case study from our website that I would like to show you, and that's on MHK. And that one closed since we were here last week. It actually closed the next day on Wednesday. So that's trade ID number 216 in our trade listing. And that is in the volatility strategy. And it was a long strangle, which are the primary strategies within the volatility strategies. Not the only thing we do, but it's what we do most often. And this had a 61.8%. I've jokingly called this one the Fibonacci trade. If you watch the 2-minute trade review on this, because that's an important Fibonacci level, 61.8%. So you can see that we entered this on May 21st. And I wanted to focus just for a minute on this pattern. Quite often I've talked about how I like it. It's my favorite pattern, bar none, for breakouts when you have a vertical move. Normally I've been showing examples of a vertical move to the upside that consolidates with a symmetrical triangle, but it works either way. And so this is a perfect example of that. Here we have a vertical break to the downside that then consolidates in a symmetrical triangle. So the same thing, it's a vertical move, it's just in the opposite direction of what I normally talk about as far as my favorite pattern. Vertical move, consolidating with a symmetrical triangle. Doesn't matter whether the vertical move is to the upside or the downside, you still have a potential for a big move, either up or down out of this pattern. And I've shown numerous examples over the years where the exact same pattern, I mean, you could lay them over each other, and if you didn't know what the security was, you'd swear it was the same stock, and one broke up and one broke down. It just, you never know which direction they're going to move. But the one thing you do know is that that pattern is likely to give you a pretty significant breakout, and that occurred with MHK. The other thing that we considered with this is it's the stock, the underlying is Mohawk Carpet, and housing has been surprisingly strong. A lot of people forecast that housing was going to really get hit hard by what's going on with the virus and the sheltering and the stay-at-home orders, etc. Hasn't really happened. Housing has still been doing really well. Well, Mohawk was behind that curve. So the housing market was doing well. A lot of other stocks in that same space were doing well, but Mohawk wasn't. So there was a little bit of a catch-up factor, if you will, for the stock to catch up with what's going on in the rest of the world. So we had a break to the upside, and normally would have gone ahead and closed that out because it gave us better than a 30% gain with that one-day move. And you get a volatility spike in the call option side of things. And as I mentioned in the past, quite often, I've gone ahead and taken that. But with that whole catch-up provision and the fact that we still had a gap up here above 100, decided to hang on. Then we get another gap the next day. Well, 2 gaps in a row, that's a lot. Now we're a bit overbought on the short term. We have the nice volatility spike in the call options continuing. That could have calmed down a bit after this big update, but it didn't because we gapped up again. Looking at the DMI, we're setting up for potentially a bullish move to the upside. So that was to the point where we said, okay, it's time to take it. 61.8% gain. And in the strangles, we look for normally a 30 to 70% profit is where those positions kind of fall. Once you hit 30%, we're looking for potentially closing it. Anything above 70 is viewed as a really good one. So the fact that we were starting to approach the upper end of the range, it was just simply time to go ahead and close that out. But what I did want to show you is to go back to this chart here and show you MHK again. And you can see there was the gap ups. Look what happened the next day. The next day, we came back down. And then we went sideways, and then we had a doji, and then we moved back to the upside. But so far, we haven't made it back to the day that we closed the position out. So our exit on the 27th here, at this point in time, looks really good. Now, maybe we continue to move up, and we go up and close this gap, which is something that we wanted to keep an eye on. So let's bring the DMI onto the screen, and you can see that we haven't had the entry signal. So watching this every day and looking to see if this does give us a directional signal to trade this continuing to the upside. We traded it from the triangle standpoint, the consolidation pattern, and we'll see if we get the signal. The ADX is moving up. It hasn't made it to 20 yet, and it's not between the 2 directional indicators. It may get there within the next couple of trading days, but it's not there yet. And then we had the 2 days where we came back down. Then we had a sideways day, a little bit of a move back to the upside today. So we made a really good exit on the MHK, taking that over 60% gain in a short period of time. And as I said, we'll watch this one. If we get another entry, we may put a position in our impulse strategy. So the strangle was in the volatility strategy. Again, primarily strangles within the volatility strategy, but the more directional stuff is in the impulse side of things. And if we get an entry, we'll take advantage of that. But we'll see how that plays out. So I wanted to go through and share that with you because that one, as I said, occurred Wednesday of last week, the day after we chatted last Tuesday night. So pretty interesting stuff as far as where we are with the market, that current position. And then let's take a look at, I wanted to show you from the past few weeks, because if you've been following these TradeFinder webinars, we've had one hell of a really good record of the case studies that we have plotted as our official case studies for the TradeFinder web series. The record's been pretty phenomenal. So a couple weeks ago, we looked at Costco. So I wanted to go ahead and bring that one up. And you can see that that one's not broken out yet. So it is in the consolidating triangle, symmetrical triangle vein, and it's just building a bigger and bigger triangle. And see where we were a couple of weeks ago, where we were here, and basically we've just built a larger triangle. So that happens at times. That's part of what occurs with triangles. Sometimes they break out great and fast like the Mohawk one did, MHK. Other times they take their time, and that just requires patience. But the one good thing about these patterns, these consolidation patterns, the triangles, when they form larger triangles like this, it's frustrating because it takes longer for them to break out, but normally your patience is rewarded. That when the breakout occurs, it tends to be even more volatile. So we had a pretty good breakout of those 2 days on MHK, but when you have one that creates a bigger and bigger, it's like really compressing that spring down further and further. So when you let go of it, it really jumps. So that's been the experience. You create a larger triangle and it's like, you're waiting and you're waiting and you're waiting. But then when it finally moves, you're like, all right, that was worth it. I'm willing to wait that long to get that big of a move. So I wanted to show you that one. And then we also did TSM. And then last week we did Monster MNST. I'll show you that one as well. So Costco was 3 weeks ago. 2 weeks ago, we had Taiwan Semiconductor. Maybe that one broke out today. Now, if you've listened to any of the recordings that I've done, if you're a subscriber to our volatility strategy with Elliott Wave Options, or you've just simply heard me talk about these triangle patterns in the past, you know that today that's meaningless. The one day doesn't mean a thing. You have to have a second day. You have to have a follow-through day or a confirmation day. So maybe we're breaking out. You can see that we had a doji on yesterday's trade and then the move to the upside today. So maybe we're starting to break out, but we have to have that second day. We have to have the follow-through or confirmation day. We just went dead sideways for basically the 2 weeks, but maybe something's starting to happen. Tomorrow will tell us a lot. And if the futures hold and the market continues, they're up nearly 9 points now. So come off a little bit, but still rallying based on that big spike of whatever occurred there right towards the close of the trading day. So that'll be interesting to see. And then our case study last week was on MNST, Monster Beverage. And we actually did send this one out as an alert to our subscribers, and it's performing very well. It's in wave 3. We had this little bit of an extended move here, and take a look at the 10-day moving average. So let me go back. Let me walk you back a day, which is really cool that you can do with Profit Source, is you can walk back and see what the pattern is. So, you go back and you talk about Monday morning quarterbacking and stuff like that, but you can literally go back and just click it off on any day and see. Some of the other software programs, when you go back like that, it expands it out and it makes it difficult to see. But here you just go back and click and boom, it erases the other stuff and you can see what happened. I think it's a great learning tool to be able to do that, to go back and look and say, okay, what was the pattern then and then what happened? That's how you learn. So just taking it back one day, you can see we were starting to get just a little bit overbought. And we actually considered closing this position, just taking this gain and letting it go. But when you look at the DMI is still really good. We're getting up towards that positive directional indicator, but the ADX is still between it. It's still moving to the upside, hasn't quite broken above 40. The positive directional indicator is still moving to the upside. So there's enough there to say, yeah, let's just hang in there and see if we don't make it up to this level, noting that we also have the zigzag pattern that's also giving us an extended target right where the wave 5 is. So we have two different Elliott wave patterns giving us almost exactly the same profit target. So we want to give it an opportunity to at least move closer to that, if not hit it. And the fact that we pulled back a little bit today from this slightly overbought condition is not surprising. It's not alarming in any way. In fact, we didn't really give up much. This 51 cents today, considering we were overbought, is a positive sign, with the fact that we could have come all the way back down towards 70, another couple dollars. It could have broken back down. It still would have been okay from a technical standpoint, but it really didn't do that. and that was a positive. So we're watching the DMI down here. We're getting awfully close to the ADX breaking above the positive directional indicator. But if the stock rebounds tomorrow and goes higher, then that'll rectify itself. But we're watching this one closely. So that one's already been profitable. Really nice move for our TradeFinder record, if you will, as well as our subscribers. So nice gain there. All right, so now let's take a look and see if there's anything that we can find for today. And I've run the search, and there are 12 results. That's interesting. Yesterday, there were 12 as well. Completely different ones, but still 12. And that's right in the area we talked about. Usually there's somewhere between 5 and 15 results based on the technical system that we utilize. So yesterday there was 12, today there's 12. So it works out the same. The first thing that I look for, and I want to go through every one of these because I want to stay on time tonight, and I also want to leave time to answer some questions. But you see Nike there, and want to take a look at that chart, especially with everything that's going on with the civil unrest, etc. They've posted a statement that was well received, and Nike's just a good company in general terms. So we take a look, and the money flow is really good. You can see that movement to the upside here. There's good money flow. There's a nice volume move today. So money flow and volume are really good. The oscillator is moving to the upside, so it's telling us the real short-term momentum. Remember, that's the 5 and 35 simple moving averages. That's doing good. The CCI, yeah, it's like, okay. We're not super excited about today's move, which in some respects is okay because we are kind of near the upper end of the range. And that's where you get the real short-term momentum indicator. We start to break above where I've drawn that line connecting those highs historically, then you're getting into a very overbought condition. So the fact that we kind of went sideways, at least it wasn't going down further. It's holding its own, if you will. And if we move back to the upside and break above here, then we're probably starting to get overbought. So we'll see how that plays out. But the DMI is about as good as it gets. That's really fantastic as far as a setup for a DMI. So you have the ADX moving to the upside, good separation in the directional indicators, the positives moving up, the negatives moving down. We're above both 20 and 25. So even if you like the more conservative settings of using the ADX, if you were with our TradeScan web series, you understand what I'm talking about as far as these readings on the ADX with the more widely viewed reading of the ADX breaking above 25, and with our entire system of confirming indicators, I think we can be a touch more aggressive and use the 20 range. So regardless of whether you're on the more aggressive side or conservative side, we're above both of those. So all of that looks really good, which then leads us to, all right, let's put the Elliott wave pattern on here. And we're currently in a corrective move, which should lead us back to those previous highs. Now, the only issue that you would talk about there is it's just not a whole heck of a lot of a move. We could break through there, but we'll probably run into some resistance there. So that's right in the 105, 106 range. So call it 106. We actually look at that high, and the high was at 105.62. So right in the 105, 106 range is where we should hit some resistance. The negative is there's a gap right there that hasn't been filled. And another gap right there that hasn't been filled either. This one got filled immediately. So you can see that we had this little gap up. That one came down, filled itself right away. But there's still two down here that haven't been filled. And then there's one way down here. So you have to be really careful with Nike. It looks like the short-term momentum is to the upside. But at some point in time, all of these lower gaps are going to get filled. So something will happen to them. Who knows when? It could be weeks, months, several months down the road before some negative news comes out and they start to peel back. But those gaps will get filled. But as I mentioned, time after time after time with gaps, they get filled, but there's no rhyme or reason as to when. So we may very well run up and hit this, especially based on how good the confirming indicators look, hit this resistance level at least beforehand. So there's, a good 5 points to go on Nike before we have anything to get concerned about. You have to decide if that's enough of a move for you to put a trade on and put money at risk. Another one that HSIC is interesting, Align Technologies. That's interesting because we're talking about the rotation that's been moving out of technology. Technology actually had a tick up today. But the technology sector has had a big run. Industrials haven't, financials haven't. Money's starting to rotate into those sectors. You're seeing them starting to come to life. The CMF looks good. Oscillator's good. We pretty much already know all these things are good because they wouldn't have shown up in the search if they weren't. CCI, this one's actually ticking to the upside. Which is even better than the signal on Nike, also with some room to move to the upside. In fact, if we wanted to have a concern here, it would be the fact that with this move to the upside today, the ADX is actually above the positive directional indicator, or you could call it exactly the same point. But the ideal setup of the DMI is not to have the ADX outside of either one of the two directional indicators, depending on whether or not you're looking for a consolidation pattern or a directional trade. Especially directional, you want the ADX to be between the two. So breaking above it, that's where you get a little bit of, we're starting to get kind of a mature move. And that makes sense when you look at the Elliott wave pattern where the wave 4 is corrected 85%. So that means that's a disqualified pattern. And so our target, kind of similar to what we saw with Nike, is a move back to the recent highs. This one has a little bit more of a move, though, from 263 up to potentially 300 to reach those previous highs. You might look at this and say, sheesh, something to be a little concerned with is we closed that gap today, but it didn't hit that gap and back off. Sometimes you see that, and that's when you're like really concerned that, all right, this move was just to fill the gap, and once it did it, that's it, and you get a reversal. It filled the gap and it continued higher, so that's a positive sign for a potential move all the way up to these recent highs. So that one looks pretty good too. We'll see how this goes as far as whether we put it to a vote or not on which one we utilize for our TradeFinder case study. Golf, anytime you see the word, for me anyway, the former golf pro, want to look at it. So this is a Kuchnet, which basically it's Titleist FootJoy. For those of you that aren't familiar with the old name for Titleist, that's what this is. So this is Titleist FootJoy. Golf is starting to gear back up again. And one could argue that maybe golf didn't get it hurt as bad as some other sports because there's social distancing already in golf, except if you're riding in the cart together. So a lot of golf courses went to one person to a cart, or if you weren't in the same household, you had to take a different cart, etc. But golf courses, for the most part, never shut down. They just adjusted things a little bit. They don't want you taking flag out, etc. Blah, blah. You don't want to hear about the whole golf thing, but good money flow, volume, oscillator is really moving to the upside. So good short-term momentum. This is a little bit more along the lines of Nike as far as the CCI saying, it's all right. We're in the upper end of the range. We're kind of moving up, not too significantly, but a pretty darn good DMI here. The ADX is approaching 40, so we want to be careful of that. We know that once the ADX gets above 40, typically that's a sign that the strongest part of the move is over. Doesn't mean it can't move higher. It just means the strongest part of the move is over. So you can still move up, but just maybe not as strong of a move to the upside. So taking a look at the Elliott wave, you can see that's in a wave 3. So that's interesting from two different standpoints. One, with a wave 3, we know it's a very strong wave. We've got good confirmation of the DMI. Two things to be concerned with in a wave 3, though, is in this case, there's decent separation between where the stock is and the 10-day moving average. So we're a little bit overbought short term. And when does the wave 4 corrective move start? Do we continue up, hit this target, and then create the corrective move? The corrective move could occur at any point in time. This 4 here labeled on the chart, and just I've talked about this before, but just to reiterate it, that doesn't mean that it's saying the wave 4 begins now. It's saying that if the wave 4 were to begin now, this is your target price of where the correction level would be, which is pretty interesting in the fact that right smack in the middle of that wave 4 corrective forecast is closing that gap. But we could go higher before that occurs. So for me, the biggest concern is that, yikes, we're kind of overbought for this stock here. Couple $3 in a $30 stock, that's a pretty significant overbought scenario. It would be difficult, at least right now, to put a position on there, even though it very likely is going to continue higher. But do we have a pullback first before it continues to the upside? So that's the only concern that I would see out of that one is, does the move continue right now, or does it wait just a bit? Looking at F5 networks, this is another one that we've utilized in the past. I mentioned in the market update that you see certain stocks that occur over and over again within good Elliott wave patterns. There's a pretty good move out of the money flow. So from negative to positive, it's moved pretty quickly. The oscillator had a little bit of a dip there. Now it's starting to find some short-term momentum. The CCI has turned back up, but you can clearly see we're not at the upper end of that range either. So room to run there. The interesting thing here is, unlike a couple of the other ones that we looked at, the DMI is not nearly as good as it was in some of the other ones that we looked at. It's like, okay, but it's not great. The positive directional indicators like, and the negative one is moving lower. So kind of stable position with the longs or the bulls. The bears selling pressure is weakening a bit, but it's not like the bullish position is taking off to the upside. And then when we look at the Elliott wave pattern, we have a pretty decent setup as far as a continuation move up to around 170. We're trading at 146, so that's a pretty good move still to occur, but it makes you wonder if that 33% corrective level is going to hold on the wave 4, or do we need a larger corrective level before we move back up? Just not as exciting as I'd like to see this stock, and kind of maybe this stock is part of that rotation that we talked about, where money is moving from some of the sectors that have done well off of the lows, trying to find some of the sectors that haven't performed as well, bouncing off of the lows. So find that interesting. So looking at the results so we had Nike. Let's look at one more. Let's look at HSIC, and then we'll pick one, and I'll take some questions so that hit my goal of staying on time tonight. So move to the upside on the money flow. Looks pretty good. Volume, really good looking oscillator. CCI is moving up, plenty of room to still continue higher here. So that looks good. Much better looking. Wow. Really good looking. Let's see what the options look like on this. Seems that I've noticed that this is headed. Yeah, there's not a huge, more than I remember, but not a lot of open interest, but enough, and the spreads are close enough together. So not bad there, but that's the best looking DMI of any chart we looked at right there. I mean, look at that. So we have have a look at that, and Steve Irwin reference there. So move to the upside here on the positive directional indicator. Now we're moving the negative one. That looks good. ADX is breaking up. We're above 25, but we're not at 40 to where we're showing a mature trend. Look at the LA wave pattern, and we're in a corrective mode here, which looks like a couple of zigzags here. If we labeled those out, I bet we would find out that we've got a couple of zigzag patterns moving here. I hate this because that looks like a bad pricing spike there. Yeah, because you can see that just, let's take that off and move to what I think is a more realistic pattern here. So we've already broken above this 100% level. So I would say that the extended C wave is well within tracks. 161.8% level is right there around 70. And in the larger LA wave pattern, what we should do is approach these recent highs. So somewhere in that area. So even looking at a 70 level would be a conservative move to the upside. And you could either do straight options or a spread here. The only negative is that you jump from July to October, so there's no August or September, so it's in that same cycle that we've viewed over the previous weeks. But even moving out to October, there's a 30 delta, a little bit wider spread. The 23 delta is narrower in spread, but that could change slightly when the market reopens. Again, based on the slightly elevated VIX, it's been difficult to look at things after hours and know where the spreads are going to be because when the market's trading, the spreads tend to narrow back up again. They just widen them with the higher VIX because strange things could happen overnight. Looking at that, though, the 23 deltas, I almost wonder if that's a bad quote because it's so much tighter than some of the other spreads are. But you could create a pretty good spread or straight options out of that one. So I like this one. So let's go ahead and use HSIC. So I'll make a note of that as our TradeFinder case study for this week. A few other ones that were nice to look at there, but we're trying to use some accountability here by keeping track of what we've utilized for our case studies. The whole idea of the TradeFinder webinars is for education. So if we don't go back and look at what we did right and what we did wrong, then we're not really getting the benefit or the full benefit of the educational aspect out of doing these. And so far, we've just had a pretty good run of things working out well. All right, so let me see if there's a few questions. I know that support there has been answering them. Some of them I've seen. Dots going back and forth on the screen. That shouldn't be normal. No, I had the reason I was a few minutes late is because of the internet issue that I had, which is unusual because I have really fast internet. So I'm not sure what you saw, Joseph, but hopefully that rectified itself. The number 313. So let me go back. Someone asked, what is the number 313? That's an important number. So let me go back. It is very small on your screen. So that's this number right here. So hopefully you can see that arrow. I realize that the print is kind of small on your screen, but 313 is where the 78.6% fib corrective level is. And that's important because so that was a good zigzag. That worked out perfectly following the rules. That was a good zigzag that worked out. But then the big picture is this could be the A wave lower. and this could potentially be, still is qualified, it's not disqualified yet, a large zigzag to the downside. But if we hit this 78.6% level, which happens to be at 313 on the SPY, that's the value, 313 on the SPY, that's where the downside zigzag becomes disqualified. Now, that doesn't mean that the 78.6% level becomes resistance and the market backs off. The market could easily back off, come down and fill this gap, etc. But what it means is that the likelihood of going down and making new lows is gone in the market. So we could hit that level, come back down, and we're probably then at that point in time creating a new zigzag pattern to where this one right here, this pattern becomes complete. So that one's done. The whole downward one is done. And then maybe we're starting one where that's an impulse move to the upside, and then we get some sort of a corrective move from there. And then, as strange as it may be for some to believe, a move to make new highs. That's a possibility. Not suggesting that that's what's going to happen. That's a possibility. Drives me crazy with the comments on YouTube when I present these alternative scenarios. People think, well, you're playing both sides. I'm not playing both sides. I've been very clear on what the current pattern is. What I'm trying to do is show you that if that pattern becomes disqualified, what's likely to happen after that so that we're prepared for it, rather than just trying to be stoic on, hey, we're going lower. Well, we might not be. That's just an understanding that nothing is 100%. As great as Elliott wave is and all the empirical data that we have showing the success ratio of Elliott wave, it's not 100%, nothing is. So sometimes patterns become disqualified and they change. And the beauty of Elliott wave is changes like that. As soon as it becomes disqualified, the new pattern's there. So you're like, all right, well, that one didn't work. Now where are we going? And then when one pattern becomes disqualified and the new one emerges, the interesting thing with Elliott wave is that has a higher percentage chance of occurring than the original pattern did. It doesn't make a whole lot of sense from a common sense standpoint, but that's the truth. So you have your original pattern, and that has its percentage of accuracy. But if that pattern fails, then what happens after that has an even higher percentage of accuracy. So it's kind of an odd aspect of Elliott wave, but it's good if you're willing to follow through and make the adjustments with it. So anyway, long-winded answer on what the 313 level meant. We want to look at MDY, the mid caps. A few guys have been talking about that on financial networks. You know, lots of gaps for an ETF with decent volume. So we're in corrective mode after that wave 5. The DMI is getting pretty interested at this point in time. It's taken a while. I mean, we've had a pretty decent move off of the lows, but you're starting to get to the point where the DMI is saying that, in fact, today was basically an entry day based on the DMI for the mid caps to continue to move higher. And they've got a gap there. The S&P filled its gap, but they've got a gap there that hasn't been filled. CCI is okay. Oscillator looks good. Man, we talked about this rotation that's occurring in the market. And if you want the market to go higher, that's what you want to see. You want to see money rotating into different sectors, not leaving the market. So if you see money leaving the market, then that's where you become concerned that you're going to see a pretty significant downward move. When the money moves into different sectors, it's staying in the equity market, and that gives fuel for the market to continue higher. It just moves into different areas. Staying within the S&P 500, you still have different areas. So there's the mid-cap 400, but that looks pretty good. I hate these gaps. These two gaps, don't like those, but the rest of it looks really good. I think there's a question on why I have the DMI set on 13 and 21. Those are Fibonacci numbers. So I have adjusted, talked about that in the TradeScan web series. This is my favorite confirmation indicator. Look at the other ones. We look at the system. Don't get results unless all of the indicators within the system have the same desired result. But my favorite confirming indicator of Elliott wave is the DMI. And so I changed these to 13 instead of 14. Some have this as 20 and change it to 21 so that we have Fibonacci numbers within what I consider to be one of the best strength and trending confirmation indicators to complement Elliott wave that exists. I think the DMI is the best confirming indicator for Elliott wave out there. Comment on a line, Steve? Yeah, if the ADX goes above the positive directional indicator, just to be clear, it's not an automatic exit signal. It's one of those things that tells you that the strongest part of the move is over. So you could very well use that to say, okay, well, that's it then. If the strongest part of the move is over, I'm out. But the stock can continue higher. It just tells you that the move to the upside here is not as strong as it was. It may continue up, but if the move to the upside is not as strong as it was previously, that means that when you get a corrective move, the corrective move will likely be bigger. So if you're in a very strong reading of the DMI and the stock corrects, usually the correction is not that big a deal. It goes down for a couple days, maybe hits back to the 10-day moving average if we got overbought, et cetera. But the corrective move is not that significant. The further you go past the strongest readings on the DMI, so it continues higher, and we're already past the strongest point, when the correction occurs after that, or the move down, the move against the previous move, that usually is more severe. So we could continue all the way up to the upside and hit this level here at 300. But what that means is that unless there is a significant change in the DMI from where we are now, meaning that fresh buying comes in, fresh money comes into this, that if we were to hit that 300 level and then correct, the correction is probably going to be pretty quick and a lot more significant than it would have been back here when we had this move to the upside and we corrected. It was like not a big deal. And then we continued up. But if the DMI is showing that the strongest move is over, when that next correction comes, it'll be far more severe than that one was. Kim, yes, all these are recorded. The sessions are recorded, so fear not. What you missed, you can go back and review. Just to review, there was a question on the stock symbols. So we looked at Nike, which was symbol NKE. We looked at Align Technology, which is symbol ALGN. Then we did golf. We looked at FFIV, which is F5 Networks. And then the one that selected for our case study this week is HSIC, Henry Schein. So hopefully that helps. John, I have not with that confirmation. I've looked at every technical indicator that exists out there. I've run tests on pretty much all of them, but not necessarily Elliott wave with the other ones. What I did was I stayed with what I've come up with here, which is a combination of confirming indicators and then put the Elliott wave on there. So I haven't run combinations of Elliott wave with the other technical indicators, if that makes sense. So I've run the other indicators together to create this system of the ones that I like and the ones that seem to work well together and the ones that have a good track record. But I haven't run where I combine Elliott wave with those individual indicators, because my viewpoint has always been, let's find a good supporting cast so we've got a pool here of stocks that we know are fundamentally strong. We know they're technically trending. All those things look good. And then let's apply Elliott wave to those. And that's been the premise from the beginning, and that's what's worked. And I am a bit of a creature of habit. Spent an awful lot of time doing this in the past, and so that's what I've stayed with over time. But always open to somebody else creating other combinations and things. And if you come up with some combination that works well, and happy to take a look at it. But that just is explaining what my thought process has been. All right, doggone it, ran long anyway. But thank you so much for your attention. Hope everybody stays safe out there. Things are crazy right now. Market looks like it wants to continue to move higher. Futures are still up, at least at this point in time. We'll see what happens in tomorrow's trade. But be safe, and look forward to talking to you again next week. Take care, everybody.